In this episode of the FXTM educational series, we're going to be taking a look at divergences, which are a technical signal that tell us something about whether or not the price is likely to rise or likely to fall. Now, we use oscillators to identify divergences, and in fact, most of them will do a fairly good job, but there's one that was created specifically to identify short-term divergences called the stochastics, created by George Lane in the 1950s. So I've drawn an example of what a stochastic oscillator looks like here on the board with a draft price chart here. Now, what are we looking for with the divergence? Well, specifically what we're trying to identify are periods of time when bottoms on the price do not equal or don't match bottoms on the oscillator. So let me give you an example of what I mean by that. Let's say, for instance, that the oscillator, which we would normally expect to be rising when the price is rising, falling when the price is falling, which you can see here, that's exactly what's going on. But what is also going on is we have a period of time when the price was forming lower bottoms, so as we go along here, but we had a suspicion that these were unstable and likely to reverse, or in other words, the price was likely to rise, because the oscillator was forming bottoms as well at the same time, but they were rising bottoms. So what that's telling us is that there's the potential that the market, at least temporarily, is oversold. And with the stochastics oscillator, if it's below 20, which is considered oversold territory anyway, the stochastics will oscillate between 100 and 0. Well, if it's below 20 on the oscillator, then that would tell us again, there's the potential here that we could see a rally in the near term. Now, there's a bearish version of this as well, where just like with the bullish one, we're looking for a period of time when tops on the price do not equal tops on the oscillator. So for example, you can see for instance of this on my chart, where I have higher highs on the price. So the price is rising, but we would consider those to be unstable highs because at the same time, the highs on the oscillator, while they're appearing at the same time, they are falling. So it's telling us that there's a potential here that the market has become overbought, and particularly with this stochastics oscillator, if it's above 80, which is considered overbought territory when that divergence appears, it's even further evidence that the bulls might be overextended here and we could see a reversal. Now, it's important to note that a divergence all by itself is not necessarily a trigger for a reversal of trend, but it is definitely a short-term signal that the trend, if the divergence is contrary to the trend, is running out of a little bit of momentum. It might be a riskier time period. We could expect some volatility. Or if the divergence appears in favor of the prevailing trend, a bullish divergence and a long-term bullish trend, or a bearish divergence and a long-term bearish trend, that the trend is likely to reassert itself and there's some opportunities for traders to enter some positions. Let's look at a couple of examples of bullish and bearish divergences. So you can see on this chart that we have lower bottoms on the price that are not matched by the bottoms in the indicators. So the bottoms on the indicator are rising where they're falling on the price, and that's a bullish divergence. So we'd be looking at that as triggering potentially bullish opportunities, especially if that was in favor of a longer-term bullish trend. Now in this chart, we see just the opposite, where the price was forming higher tops, which were accompanied by tops in the indicator, but they were sequentially lower. Now that mismatch tells us that those tops in the price are relatively fragile or unstable and likely to reverse, at least in the short term. So divergences can help us to identify periods of time when there's greater risk in the market, as well as when there's opportunities to enter the prevailing trend in favor of bulls or bears when that trend is likely to reassert itself in the near term.